In today's video, we are talking about the Nasdaq index, more specifically Nasdaq futures, and even more specifically options on the Nasdaq futures index. And the reason why today we're going to be focusing on options, it's because we have a very interesting setup in front of us. On one hand, we have a market which has shown weakness into the end of last year. But on the other hand, given the current trend and given the candlestick type of analysis that we could do on a weekly time frame of the Nasdaq futures chart, we can see that there is potential for a breakout to the upside and for the Nasdaq to begin making new all-time highs. Now, having said all of that, this is the opportunity. We also have the risk. As we said, the risk is not only for the breakout to fail and become a fake out, which is indeed a possibility, but the risk is also the fact that we have seen some relative weakness. We've discussed that in prior articles in our predictive profile page, which you can see on the screen as we speak. If we were to keep in mind some of the weakness I was referring to that was identified and documented in those prior articles, obviously the risk of a fake out becomes greater. And in this sense, a trader or investor focusing on risk management may want to have extra tools to protect the downside.
Are you ready to level up your trading skills? Visit and follow our TradingView Ideas page. You'll get actionable insights and training materials for free. Scan the QR code or use the link on the screen to keep in sync with the markets.
In this case, we're going to be using options in an original manner to provide not only limited risk to the downside, limited risk no matter what, but on top of that, we will also provide a buffer that allows for the trade to be wrong by a certain amount without really suffering a negative P&L. And then, of course, we do want that if the breakout does take place, of course, we want to profit from such breakout and potential new all-time highs being produced. The solution to all those various needs is in the form of options trading, where, as you can see on the screen, we will be utilizing two puts, more specifically the 22,000 put combined with the 21,000 put, and those would be creating what we call a bull put spread. So we are targeting 22,000 because this is the price level where we have unfilled orders below price, unfilled orders to buy, UFO unfilled orders. Therefore, if the Nasdaq was to fall sharply, the moment the Nasdaq would reach these price levels, the expectation would be for the Nasdaq to bounce back. In other words, we are willing to take risk around those UFO levels because the likelihood of price to continue going lower is limited, and therefore taking the risk at these price levels seem to be a smart thing to do. Therefore, again, one more time, we are producing a bull put spread made of selling the 22,000 put combined with buying the 21,000 put. Those two create a credit that then we are going to utilize to buy a call. We're going to buy a call above price thanks to the credit collected from the bull put spread, which is where we are taking the risk. Therefore, if the market goes up, the call will produce profitability. The bull put spread will also produce profitability.
If our videos help you stay sharp episode after episode, hit pause, like, subscribe, and keep learning. Your support means a lot to us.
So all combined means if the market goes up and we do have the breakout, we will begin profiting. If the market was to go down, of course, now we have less of a good news. We have a little bit of a problem in our hands, but really the problem begins below the strike 22,000. And the problem actually ends below the strike 21,000, which is where the limited risk will take place. In other words, the maximum risk of this trade is 1,000 points, which is the distance between strikes. Anyway, a little bit more here when it comes to understanding the options play. We're gonna see this here expanded, and this hopefully will be useful to understand. So here's the risk profile of this option strategy. We can see a pretty great win rate. Of course, this is calculated using pricing models, and reality is different than models, so this is just a reference number. But basically the blue line, the dotted blue line, is the one blue line that would be useful to observe, which is if the market goes up, the blue line will begin bringing in profitability for us, of course above the call strike, which is 28,750. Even after expiration, we would be, even at expiration to say, we would be in a position of maximum profitability. But in any case, the trade would start profiting right away if the market goes up. It's a positive delta trade. As we can see, if I move to deltas, we can see we have a little bit of a positive delta that would increase as the market goes higher. If the market was to go lower, of course, we start losing money. But notice that as we are also approaching the expiration date, we will end up meeting that green line.
Are you ready to level up your trading skills? Visit and follow our TradingView Ideas page. You'll get actionable insights and training materials for free. Scan the QR code or use the link on the screen to keep in sync with the markets.
The blue line will become the green line, and therefore basically we will end up with a break-even trade unless we are trading below 21,293 right there, which is the break-even point, where from there we will collect a net loss. But as said, the maximum size of the loss, no matter what, would be 1,000 points. So this trade has been illustrated utilizing Nasdaq futures. The ticker symbol you can see on the left is NQ. This trade can also be executed copy-paste really with MNQ instead of NQ, which is the micro futures contract. So we would be utilizing micro future options on the Nasdaq index futures instead of the E-mini, which is NQ. So NQ or MNQ, that is your choice, and hopefully this educational explanation is enriching your understanding and use of options with a little bit of a creative approach today, which again, hopefully you have enjoyed. Thank you so much. See you in the next video. And of course, priority in trading is managing risk as well as managing trading emotions, which is another source of risk, isn't it? Let's do all a great job out there, and let's enjoy the markets in this beginning part of the year. See you in the next one.
If our videos help you stay sharp episode after episode, hit pause, like, subscribe, and keep learning. Your support means a lot to us.